So this is the Planning in Uncertain Times webinar. We will be going through a presentation today outlining our best use cases for using AI and ML in planning. Without further ado, the purpose of today's webinar is we'll be going through some of the common challenges and pain points within forecasting. As everyone knows, during this time period of COVID-19 and this time of uncertainty, those plans that were made early in the year in 2020 are changing very rapidly. And so we'll be going through some of those pain points. We'll also take a look at how AI and ML can help in that cost analysis and that planning process. And we'll go through some case studies and kind of give you guys a peek under the hood of what our methodology and approach is in forecasting. So without further ado, I would like to introduce our main speaker for today. It will be Tony Nash, our founder and CEO. He doesn't like me saying this, but he's been in the market insight and business intelligence industry for decades. So he started as the head economist at the business unit for The Economist magazine and headed up their research division for their B2B arm. And then he also headed up the Asia division of IHS Markit. So he's very familiar with what companies are needing in terms of the planning process and the forecasting process, and has a lot of insight to bear, not only on the economic side, but also how AI and ML can help in that process. So without further ado, Tony, I'm going to turn it over to you to take us through the presentation.
Great, thanks, Jacqueline. And thanks everybody for joining us. I know you're busy during the day, and I'm sure you have a lot on your plate today. So it means a lot to us that you've joined us. Jacqueline, I don't have control yet, so as soon as I have control, just let me know. When we when we entered into the COVID era, the uncertainty that was in place at the time really surprised everybody, as you all know. And we started communicating with our clients with a kind of, we're here to help. Jacqueline, if you don't mind just moving to the next slide, please. We started communicating with our clients with kind of a we're here to help email. And I think people initially responded really well to that, but it quickly moved beyond that. I think the fear and uncertainty early in COVID moved to a desire to figure out how we piece the world back together as we re-engage in the COVID era. So as you all know, we're in a government-imposed recession right now. These are not market factors that have gotten us where we are. In March, governments around the world shut down their economies and made business planning, selling, cost planning, these sorts of things all incredibly difficult and different. I think from where we stand right now and the questions that we're getting from our clients right now is really, what do the next 30, 60, 90 days look like? People are really trying to get their arms around that first, and then they want to look at the next 9 months, year, 2 years. But what's happened is so different that they're just not sure how to put that plan together as they get the demands and requests from their management teams to figure that stuff out. So what we've done, and we'll go into this in a lot more detail, is over the last few years, we've built an artificial intelligence platform that's been proven with market forecasting, which is commodities, currencies, and equity indices. And we have a number, we manage 2 error rates. We want our clients to understand our error rates so that they can better manage their business. So we can talk data science all day long, and we're happy to do that. But at the end of the day, our clients want to understand how risky it is to make a certain plan. And that's what we want to help them with. So we're seeing that businesses are starting to use larger data frames, larger data sets. They've had these data on the shelf for years, and they haven't necessarily mobilized them. So we're helping them do that. We're also finding with clients that those larger data sets are hard for human beings really to conceive of. And so we're using these large data sets with within a very large computation engine and a low error environment. And we're finding that the approach we've taken to an artificial intelligence platform, of course, they're not all created equally, but the approach we've taken has really been able to digest and process those data and give our clients results that they can plan their business around. So as we move into just making the first assessment of the post-COVID world, trying to change to the next slide. Jacqueline, I'm sorry, can you please change to the next slide? I'm not having any success here. So really our biggest risk right now that we see, and you've seen this with oil and gas prices, you've seen this with equity markets, but one of the biggest concerns we have right now is a deflationary spiral. And what that means is the pricing levels decline. So initially that may sound like a very good environment. It may sound like, you know, you're going to fill up your car for less than 20 bucks, or it may sound like, you know, you'll buy your groceries for less and that your budget goes a lot further. And that's true initially. But the real problem with the deflationary environment is that then translates through to things like wages. So when, let's say your employer maybe reduces your salary, or you're laid off and you try to get another job at a lower salary. So these things tend to reinforce each other, whether it's prices or wages, and that's a deflationary spiral, okay? So we started talking about the potential of a deflationary spiral a little over a month ago, and our data bore this out. And what we saw was that China will likely see deflation starting in Q2. They were almost there in Q1, but in Q2, China will start to see deflation, and it's not a small hit to their pricing levels. A real problem with that is the number of people who've been laid off. So we've seen estimates of potentially more than 50 million, potentially more than 100 million people in China who've been laid off during the COVID era in China. And because demand is not necessarily coming back as quickly as they need, we've started to see this deflationary spiral in China. Now, our worry, and what you see on the chart in front of you, is US, China, and Germany. Our concern is, does China's deflation translate through to the US and Germany? I think, in fact, we'll see those markets gently dip into deflation, which is kind of a tough concept to grasp, but I think we'll see them cross the threshold into deflation. Europe will certainly see it. Workforce issues and so on and so forth. So Europe will see it faster. The US may see it as well, but it's likely, say, late Q2 or Q3 before we start to see that in the US in certain segments. So part of the issue with the deflationary spiral is around manufacturing. So because we have government-imposed recessions globally, we have a major demand problem. And with a major demand problem, we have a supply overhang, and it takes us months to kind of work off that inventory supply that we have. And so we typically start to see a decline in manufacturing, or as economists call it, industrial production, in the wake of a recession when there is a demand problem. Now, again, we started talking about this 4 or 5 weeks ago, and people thought we were crazy saying that China would see a serious negative spike in their industrial production or manufacturing. But what we've seen is that's really come to bear in China, Germany, and the US. I was talking yesterday with an oil and gas expert, and she was telling me that we now have a 3 or 4 month overhang with crude oil. So we could stop producing crude oil today, and we could live off of that for the next 3 or 4 months globally. So the further this demand problem goes, the more that overhang hits the economy, and not just in crude oil, but in cars, in iPhones, in other things. Okay, so in order to get rid of those things, we circle back to deflation. So the demand problem translates to a supply problem, which translates to a wage problem, which translates to deflation. So these are really, really kind of head scratcher issues that every manufacturer is looking at and trying to figure out how to navigate around this stuff. So with that as a backdrop, the people we work with every day are people like you who are really trying to figure out their way around this. And you know, the issues haven't changed, although the backdrop has changed, the macro environment, and a lot of other things have changed, and some of the processes will change in the wake of COVID. The same issues around predicting price and costs based on drivers, around identifying risks, around identifying the impact of these things, especially around unexpected events, and then looking at kind of the gradual regulatory and geopolitical issues, all have to be baked in to the approaches that the people we interface with, that our customers take in. So, you know, we see clients who really are looking at all of these different environments, whether it's the Fed, whether it's their internal data, global currencies. There's so much happening that a human being with an Excel sheet just can't process it. And that's really where we're helping people out. And so with traditional forecasting methods, we've seen a number of ways that people contend with traditional forecasting methods. You know, the first one is to pad the budget. So if you're looking, for example, at a consensus forecast and you assume that it's really not right, the conservative thing to do is to pad a budget by 10 or 20%, a cost budget. That's one option. Another option is to have hundreds of spreadsheets on desktops, on network drives, on emails floating around a company, which every major manufacturer has this issue. And we're helping people stop that, to have a single source of looking at the way they forecast costs, the way they forecast revenues, and other aspects of their planning processes. It's also possible to just rely on consensus forecasts. I mean, we hear about people doing that all the time, and it's easy to point back and say, well, company X said this, so we use that number. Very few people lose their job over that, but it's not necessarily the best way that people can plan specifically for that industry. And there's also custom reports that people can do. They're expensive. They're highly qualified by the people who do that. I used to make a living doing that stuff when I was with The Economist, and it certainly creates a lot of revenue opportunity for the vendor, but there's also very little accountability for the vendor. And when we talked earlier about error rates, we stay accountable to our customers by tracking our error rates every month. And so we're not suggesting people pad budgets. We're not suggesting people do custom reports. We're suggesting that people take a consistent and disciplined and repeatable approach to calculating their costs, calculating their revenues, and doing their planning processes. And what we found consistently is the error rates with things like consensus reports and internal forecast are typically double digits, and you'll see that on the next slide. And we've focused on developing a low single-digit approach across industry sectors, across portions of the supply chain. So our aim is to have low single-digit error rates whenever we engage with a client, when they may not actually measure it, but when many of the clients that we talk to have 20, 30% error rates in some cases with portions of their planning process and portions of their supply chains. So I think it was Andy Grovit, the former CEO of Intel, for any of you who are old enough to know who he is. He talked about measuring what matters, and that's really, really important for us. So what we do, we just put this analysis together recently in the beginning of 2020, where we wanted to measure our performance across a number of different commodities, energy, metals, and precious metals. So sorry, energy, industrial metals, and precious metals. What we did here is we looked at consensus forecasts, and we took consensus forecast data from the report that is referenced just below the data table there, okay? And so these are consensus forecasts at each of these time horizons, June, September, and December. That's in the yellow. What we have in blue is our complete intelligence forecasts. And then in gray is the actual, okay? So we took a very detailed approach to this. And on the right-hand side of that table, we're measuring error rates. So we measure error rates using mean absolute percent error. So we're measuring absolute percent error. So if your error rate is positive one month and negative another month, in the way we measure error, we're not able to offset those so that they come to a lower number, okay? We're very hard on ourselves in looking at the absolute numbers, and we measure our competition the same way. So what we see here with, you know, Brent crude, with WTI, with metals, with aluminum, nickel, so on and so forth, we see double-digit errors for consensus pretty much across the board, okay? When we get to some things like lead or tin, there are some single-digit errors. But we've flagged where CI performed better than competition or the consensus, and then we flagged where consensus performed better than complete intelligence. And I'll give you a couple of examples here. So if you look 3 rows down on natural gas, the consensus error rate for June is 32.6%. The complete intelligence error rate is 11%. So this is for calendar year 2019. Now, in October of 2018, we were selling to a natural gas fund, traders, and they were evaluating our platform, and we showed them our results. This was in October of 2018. And they looked at our forecast and they said, you can't be right. You're showing like a 32% decline in natural gas prices over the next 6 months. And they said, thanks, but no thanks. You know, we'd really rather not work with you. And that's fine. We moved on to the next client. But what happened was there was actually a 41% decline in nat gas prices over the next 6 months, somewhere in that ballpark, just over 40%. So these guys were relying on consensus forecasts. So if they relied on those forecasts, they would have had a 32% error in their nat gas prices over the following 6 months. Whereas with us, yes, it's double digits, it's almost 12%, but it's 3 times better than the consensus forecast for natural gas. So we have lots and lots of those examples to talk through, but that's just one where an 11% error rate for us may not look great, but compared to the consensus error, it's actually 3 times better. So there's a significant improvement when using complete intelligence. So we wanted to walk through some examples for you to show you how people are using our capability. Of course, we have a subscription product called CI Futures where you can get about 800 markets forecasts, commodities, currencies, and equity indices every month, updated actually twice a month now, at the start of the month and mid-month. And you also get, as far as we know, the largest trade forecasting database and one of the largest economics forecasting databases in the world along with that. So it's about 1.1 million unique forecasts that are updated every month. But these are some industry case studies to show you how clients are applying what we're doing. The first one to talk about is an oil and gas firm. We're based in Houston, so of course we're going to see a lot of oil and gas firms. And so this firm is a refiner, and they wanted to look at crude oil crack spreads. So they were looking at crude oil forecasts. They were also looking at crack spreads, which is the differential between the refined product and the crude product. They also wanted to look at natural gas prices and natural gas to liquids price. So they had feedstock from multiple locations. They had refineries in multiple places. So we took those data, we ran them through our process, and over the 12-month period that we forecast, we had about a 3% absolute percent error. Okay, so they were going from, again, relying on consensus, relying on judgment calls, relying on very conventional ways of doing things. And they moved to us, and we had a low single-digit error rate. So, you know, this was a really dramatic move for them, and it was actually their first move into trying out machine learning approaches. Also in real estate, we were asked to look at loan products in Kansas City, Missouri, and some cities in Iowa as well. We were looking at home loans and construction loans for this client. And we successfully forecast those real estate prices with about a 4.7% error rate over that 12 months. So as you can imagine, as real estate prices, this was in 2019, real estate prices were actually doing quite well in that region. And so again, we helped them with a pretty low error rate there. For another client, and we have a number of food and beverage clients. So for another client, they look at sugar among a number of other agricultural commodities that they look at. With this chart, well, on our standard product, we have a base, low, and high forecast outlook. So on this chart, the blue line is our base forecast. The orange line is the high, and the gray line is the low, of course. The yellow line is the actual performance. So what this forecast says, this was done in December of 2018. So what you're seeing is a month-to-month outlook, a monthly interval outlook with our sugar price from December of 2018 with the actual price overlaid it. So we pretty much got the sugar price bang on in that one single December 2018 forecast. Although, as I said, now we forecast twice a month. At the time, we were only doing monthly forecasts. So at that point, we had about a 2.3% absolute percent error for that client. So again, this is helping them better plan, helping them better understand where their markets are going, and helping them better allocate spend across bills of material. So it's really that bill of material level forecasting that we're helping manufacturers with so that they can identify with which vendors, in what regions they can and should spend, and also how to come up with negotiating strategies across their product portfolio. And then a more recent one, as we moved into the COVID era, in February, as we saw markets begin to move to the downside, this was before the government's closed economies, our crude oil and equities forecasts were almost embarrassingly low. They were lower than 0.5% error rate. So, we saw the risk that was coming to the market. And when I say we, I don't mean humans. We don't have human intervention in our process. We have 100% automated process from data collection all the way through publication. So our process saw the volatility in the markets, understood where those prices were going, and adjusted our forecast accordingly. So at the time, now a $50 WTI price is a dream today. I think it's trading around 12 bucks or something. But just a few months ago, this was actually a negative outlook on oil prices. So as we entered Corona, we were tracking this very closely and tracking these commodity and equity markets very tightly. Okay, so we have a lot of case studies and a lot of examples we can talk through. So if you're interested in talking further and asking questions, please contact us after the webinar. We'd be happy to talk through that experience. Before I turn it back over to Jacqueline, I want to talk through our methodology a little bit and our core platform. So our core platform is called the Global Cognitive System, and we've been working with this for a few years now. We have about 15 billion data items, close to 16 billion data items in that core platform. We cover almost 1,500 industry sectors across almost 200 countries. And so we're taking all of that information in, along with, say, currency and commodity and equity information, to track volatility in markets, to track funds movements, to track goods movements, and to track fundamentals across the global economy in almost every country on Earth. And so we do this, as I said, twice a month to account for movements in the world economy that also allows us to better fold in volatility. So we're doing tens and at times hundreds of millions of algorithmic calculations to bring our forecast to publication every month. We use a continuous learning approach. It's an ensemble approach with more than 30 methodologies. So what we're doing there is we're using technical methodologies, which are more kind of short-term approaches. And we're using fundamental methodologies, which are more medium-term to longer-term approaches. And so we're blending those together. And when we talk about an ensemble approach, these 30-something methodologies now are acting somewhat similar to neural networks, and they're competing against each other. And we're weighting the results of those methodologies for every single individual asset we forecast. So it's almost as if gold has its own DNA, and copper has its own DNA, and the Japanese yen has its own DNA, and the S&P 500 has its own DNA, and a component for a manufacturing client has its own DNA. And so we're recalculating and reweighting that every month to adjust for movements in the world economy. And our platform remembers and learns from those changes every month. So we do that for client bills of material, and we do that for publicly traded goods. And of course, we backtest and we use in samples for all methodologies across every asset that we forecast. So it's very thorough. And again, we measure ourselves based upon error. So if you're using challenge you to ask them their absolute percent error over the last year. Ask them to update their error rates for you every month. I seriously doubt they'll do it because we're the only ones we know of who do this, but it would be a great challenge to understand the value of the forecast data that you're getting from your vendor today to ask them to give you error rates on the forecast you receive. And as and when you receive them, please contact us. We'll show you ours. You don't even have to show you what your current vendor has. We'll show you ours and we'll let you do the comparison. So anyway, I'm going to turn it over to Jacqueline now. I just want to thank you for your attention today. And if you have any questions, I hope you'll put them in the Q&A. But if you have any questions after, please follow up. We're happy to address any questions you have.
Excellent. Thank you very much, Tony. And we'll be getting to everyone's questions here in just a moment. Had some excellent questions come through, so would love to get your feedback on that, Tony. So just to recap, so some of the benefits of using AI and ML, such as what Complete Intelligence offers within your planning process, is that it allows you to have your business information in the context of what's happening within a global economy, because you're able to take all of this information, a much wider data set, and then analyze your internal data in comparison with what's going on in the global economy. It also, we've noticed with our clients, has really been able to reduce their decision cycle time, especially as we're able to do these forecasts on a mid-month basis and monthly basis, versus doing a forecast once a year or once a quarter. It has allowed them to have data available in more real time, so that they're able to make decisions based on that more quickly. And then it also, as Tony had rightly mentioned, we're highly focused on accuracy. So how close can we get our accuracy and error rate to 0? How close can we get those in those single digit numbers? And then it also allows your company and team and empowers your members to really focus not so much on crunching numbers, but how to use that data and understand the whys behind that, and understand more proactively how to take action on what those forecasts are presenting with you. So I'll touch real briefly too. Tony mentioned this throughout the webinar. So we have 2 products. We have our CI Futures product. So we do about 1.1 million forecasts every month. These are both trade and economic forecasts, and also commodities, currencies, and equity indice forecasts. So these are publicly traded items. And so this is a standard login tool. Happy to run you through a demo if after this call you're interested. It's a very plug and play, easy to use for your teams. We are also on Bloomberg with this information. So if you have a terminal, we're accessible through Bloomberg. And then also later this year, in a couple months, we'll be up on Refinitiv as well. And then we also have our cost flow product. So if you are a manufacturer, let's say you're a cereal producer or you're manufacturing cell phones, we're able to provide forecasts on each of those bill of material items and each component within that product. So this is a highly efficient way to do planning for your bill of material items and for your products and product categories. So again, if you're interested in this, happy to jump on a demo and walk you through this platform after this presentation. So, and how this works is basically we're just integrating with the client ERP system and ingesting that data. It's a very simple process. It takes typically about 90 days for us to get set up and get started. And then we're also partners with Oracle and with Microsoft. So if you're using those cloud platforms, we integrate seamlessly with those. So without further ado, we'll go ahead and get to the questions. I also have some informational items up here as well. So after the webinar, if you'd like to join our newsletter or request a demo, there's some links there as well. And then of course, please follow us on our social channels. So Tony, so we have a couple questions on here. The first one I'm really excited about, really great question. So the question is, how long will it take oil price disruptions to be factored into forecasts? And I think you could extrapolate this to anything really. How long does it take, a certain disruption in the market to appear within a forecast?
Okay, thanks. That's a great question. So the way these are traditionally done, the way, say, this type of disruption is traditionally done, um, some kind of man behind the curtain or woman behind the curtain of a forecasting model says, you know, I really think oil is going to go to $10. It's going to stay there for 6 months. So they force their model to see crude oil at a certain price for an extended period as one of their inputs to their overall model. We don't do that. We factor this stuff in every time we iterate our forecast. So how long will it take for it to be factored in? We do that right away, and we've been doing that already for 2 months. In the example I showed you, we started seeing this in February, and as oil has iterated down, we've also taken that in stride in real time. So we're taking in daily trading prices, and we're factoring that into the information we forecast. So I hope that helps. If there's any more detail we can provide on that, please let me know.
Okay, excellent. Thank you. Okay, so the next question, I guess it kind of goes along with that, is that how, how do these forecasts, or can these forecasts incorporate demand? So does this forecast take into account demand?
Okay. Yes. So the way our platform works is we look at a global supply-demand balance. Of course, there are leads and lags in supply and demand. You don't eat something the moment it comes off of a conveyor belt, but we take into account a global supply-demand balance across the industries, the 1,500 industries that we cover, and global trade, and factoring in global economics, and it's adjusted by currency movements and other factors. So demand is calculated in there. We look at the world economy almost like a balloon. So it's a closed system. So things things add up to a whole within our model. In the same way air can't get out of the balloon, our model looks at prices and looks at demand and supply as a finite sum. And that actually helps us move our prices and move our calculations to show the trade-offs in the world economy. So again, if you understand how normal forecasting is done, these are typically done in discrete, oftentimes Excel spreadsheets, where they don't interact with other aspects of markets, the global economy, supply demand variables, and so on and so forth, sentiment. We actually do. We do factor that stuff in so that the trade-offs are tracked in a very timely manner. Okay, great. And then this is an interesting question. So how long does it take to do a forecast? And I'm going to add on to that question as well. So because I know what the answer is, but so how long does it take to do a forecast? And then as an add-on to that, maybe you could explain a little bit more the history behind CI in our platform and the development of how long it took us to get to the point that we're at now with our AI ML. Okay, sure. So the last forecast that we did, taking into account billions of variables, hundreds of millions of calculations, took us less than an hour. I think it was 47 minutes. And so, we've really calibrated this to look at the entire global economy and look at, thousands of product lines in a very quick manner. So we can do it that quickly because our full process is automated. Again, we don't have a team of 50 people sitting in, the Midwest or in Bangalore or Hyderabad or somewhere else manicuring our forecasts. We do it 100% with machines. And that allows us to run a script, use a lot of processing power, and deploy a forecast very quickly. So when we started the company, we really started Complete Intelligence for two reasons. When I was at both The Economist and IHS, my clients would come to me and say, industry forecasts are terrible, and B, they would say they're not getting the right context of the forecast. So it wasn't their refined product. It wasn't the sugar that they bought. It wasn't the metal that they bought. It wasn't the component that they bought. So they could maybe infer some movement from this, but they couldn't necessarily apply that themselves. So just this morning, I was talking with a major global mining firm, and they use a limited number of fundamental economic data, like 5 variables, to do their demand forecasts. Okay, we're using about 1.5 million potential variables to account for every single configuration and factor that could happen within the eventuality for their industry. So where they're using 5, we're using 1.5 million across 30 different potential, 30-some different potential methodologies. So it's extremely comprehensive. So the 2 requests I got when I was with my former firms, the CI Futures, which is our core product, is the answer to forecast error. Cost flow is the answer to the context. So we're really working to make sure that clients can actually use what we're doing.
All right, excellent. Well, I think that covers the questions that we had. So we'll go ahead and wrap up. I want to thank everyone for joining us today. Thank you for your generous amount of time that you've given us. Again, if you have any questions following this presentation or would like to reach out to us to continue the conversation, we'd love to hear from you. Please visit our website, completeintel.com, or connect with us on LinkedIn or Twitter. I included Tony's Twitter handle up there as well, if you'd like to follow him. Very entertaining, so I do suggest that you follow him. So thank you all, everyone. We will stay in touch. Bye-bye.
Thanks, everyone.